Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we look at the latest government spending and surplus figures, which show the global credit crunch hitting the bottom line hard and government spending still growing twice as fast as revenues. And we'll look at another local casualty of the global credit crunch. Investors in PINS notes face losses of over $17 million. Firstly, we look at the latest Crown accounts for an indication of what's happening to government spending and what that might mean for interest rates. The government's budget surplus slumped in the first half of the financial year. Now that's mainly because investment losses from the credit crunch hit the government's bottom line. These are nominal losses because the Cullen Fund still holds its assets and won't be realising those losses. But regardless of the short-term blip in investment returns, government spending is growing twice as fast as revenue and at least twice as fast as nominal GDP. The government's so-called operating balance slumped to $815 million in the 6 months to December 31st. Now that's down from $4.2 billion in the same period a year ago. That's thanks to an $811 million deterioration in the government's core spending versus taxation equation, and then there's a nominal $1.8 billion loss on investments in the New Zealand Superannuation Fund, that's Cullen Fund, and other funds such as ACC and the EQC, the Earthquake and War Damages Commission, because of global investment market turmoil. Now, core government spending, that's the thing to really watch, grew 10.1%, while core Crown revenues rose 5.2%. One big contributor to the revenue growth was residential withholding tax for all those people with money in bank term deposit accounts and finance company debentures. That number rose 21.9% to $1.27 billion because of higher interest rates and an influx of cash into those accounts. Social security and health spending were the big culprits, while transport and communications spending was up because of extra spending on infrastructure, and economic services was up largely because of government contributions to all those KiwiSaver accounts opened in the last year. The Reserve Bank will be watching these figures closely. It has already warned the government that spending is growing too fast and it's contributing to inflation. These numbers provide no reassurance that the government's inflation contribution is lessening. If anything, it's growing. Now for more news of which New Zealand investors have been hit the hardest and most directly by the global credit crunch. Investors in the NZX-listed packaged income notes, PINS, promoted by ABN AMRO, are now lumped in with those of Macquarie Fortress notes as victims of the global credit crunch. PINS owners are sitting on losses of at least $17.4 million from the $81 million they invested. Owners of Macquarie Fortress notes are nursing losses of about $19 million on the $29 million they invested. PINS has announced that the Australian-based fund manager for the assets underneath those notes has been wound up. PINS notes were designed as a capital protected and leveraged play on corporate debt and mortgage-backed bonds. They were issued in 2005 and 2006, and they offered an interest rate of 9.25%. The PINS notes have already suspended 2 quarterly interest payments, and PINS has indicated that further interest payments are unlikely because of the poor performance of the underlying assets. If the capital protection providers, and the ABN AMRO and Barclays, are forced to liquidate the assets and exchange them for cash, then the promised returns of 9.25% per annum are also unlikely. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Tuesday.